Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for May 14th of 2023. Please see our disclaimer for important information. Got a lot of information to cover this week, and we'll start off with the Consumer Price Index and inflation, can get into some other very notable economic data that's released and some observations as well. But here we have the CPI, 12-month change. You can see it rolling over. You see the overall number in the gray, and then blue represents the core, which is ex food and energy. You can see that that's a little bit stickier than the overall number, albeit coming down. There's some reasons why we do think that CPI will continue to trend lower, but it's going to be a bit of a slog. And the metaphor that I've used over the last month or so is that when you leave on vacation during the summer, you turn up your thermostat. When you get back and you want to get it back to your preferred temperature range, it just takes a while. And this is what we're talking about here. We've got very notable items, wages and rents, that are sticky, and we see both at relatively elevated levels. And as you'll see in a second, we've had goods inflation roll over, replaced by acceleration in services. And so those things have to play out, and there is a timeline for that. And we are on a favorable trajectory when it comes to inflation and policy changes, particularly with regard to the Federal Reserve and monetary policy. Those transmission effects just take a while to manifest in the real economy. And so we have yet to, I think, let that play out. And I think most of the Fed governors now, again, they've already made one policy mistake in waiting too long to address this, which had a whole host of attendant problems and kind of led to Silicon Valley and some of these other things with the rapid rise in rates last year. But they certainly don't want to make a second policy mistake, and so they're very careful not to, be very thoughtful about not overdoing it and raise rates too much to send us into a deeper recession. But I have noticed that there are a number of Federal Reserve pundits and folks in the Federal Reserve that are still in favor of continued rate increases. So we'll have to watch and see how that plays out over time. Here's the CPI 1-month change. You can see in the bars the elevated range that we've witnessed over the last several years here. And again, the 1-month change may be coming off its peak, but it's been very sticky. And so we watch this data on a monthly basis, and it's clearly at an elevated pace, perhaps decelerating, but it's still at a very high level. Here's a quick look at the goods versus services that I mentioned before. And you see here in the blue, this is the goods inflation. You can see how that peaked during the post-pandemic era when we had high commodity costs, commodity cost inflation. Now that part was transitory, and we knew it was. And it did come down as we expected. It kind of hooked back up a little bit lately, but it's at a lower overall level, albeit at a level that's above the trend line that we've gotten used to over the last several decades. Now, the services inflation, which is in the amber line, you can see how that has perked up and honestly accelerated at a lag to the goods inflation. And you can see here now at 6.8% that's kind of tailed over. And so hopefully here the expectation is that amber line, you can see that little fish hook tail down, that it's going to continue to trend lower at the same time that we continue to see the moderation in goods inflation. Here's a CPI on a 12-month change, kind of broken down by these key components. And so, you see the overall line in the gray, and we saw this in chart, a few charts ago. We see the overall number if you back out shelter in that light blue line, and so, and then of course the shelter in the amber line. And you could see in the shelter line that we may have seen a peak in this. Now, shelter is dependent on prices, and There's, say it loosely correlated with home price inflation, which obviously we saw a lot of last year. And now we're seeing very notable increases. About a third of major markets are actually in outright price decline, and a price decline of some measure, including the Austin area, which is one of those net beneficiaries of the pandemic and this relocation, lifestyle change that a lot of people made to come to areas that, like Boise, Idaho, in addition to Austin, were areas that were net beneficiaries of that. So we witnessed a lot of home price inflation, and so shelter, as it were, it kind of works at a lag to that, anywhere between 6 to 9 months. And so we see shelter moving higher at the same time that we see other components rolling over. And if you can read into that, the difference between the overall number and the CPI less shelter, this is the trajectory that we're going to get used to. And at some point, the shelter is going to roll over. In fact, it may be in the early stages of doing that. And looking at that rents issue here, we have Zillow observed rent versus the CPI for housing. And so this is something that is really foreshadowing that rolling over in rents. You see the in the blue line, that's a Zillow observed rent index, and you see the correlation here between that and the CPI price index for OER, owner's equivalent rent. And so this is meaningful in the sense that again, this works a little bit at a lag, as I mentioned, 6 to 9 months for the most part, but we have yet to see that that CPI change. Now we do see the Zillow observed rent index already rolling over, but it's not manifesting itself yet into that CPI number, but it should here very shortly. Here is the PPI and CPI. These are producer prices overlaid with CPI. And so, the data that we got in both of these categories here in the last data reading is that, PPI increased less than what we thought it would. And we know producer prices, and we just saw the goods price inflation be, somewhat benign relative to more recent history there. CPI remains a little bit sticky, but producer prices tend to foreshadow consumer prices to the extent that those price decreases are passed along to consumers. And so again, when we talk about CPI, consumer prices, PPI, producer prices, that we do have this fairly dramatic deceleration in PPI relative to CPI right now. We see here we've got in the blue line, we've got PPI, producer prices, ex food and energy. So these are core producer prices year over year. And then overlaid with that is the core PCE deflator ex rent. What does that mean? That is actually the Fed's preferred measure of inflation, personal consumption expenditures. And this is backing out rent. So again, that volatile component that we just saw. And so, with this and Pantheon Macro does good work here. And so they have a forecast of this continued deceleration in PPI that we just talked about. And so you can see the really tight correlation here between consumer prices, again, core PCE, Fed's preferred measure of inflation, that works in tandem with the declines in PPI. And so this is kind of my backup to this theory that further declines in PPI will help to contribute to a deceleration in consumer prices. I thought this chart was really interesting because it talks about China PPI. So when you look at emerging markets, and particularly markets that tend to do a lot of manufacturing export, so China obviously being that to the rest of the world. And so and this is an overlay of China PPI, China producer prices on a year-over-year basis in the black line there, which has obviously come down quite a bit and frankly in negative territory right now. And so you overlay that with core PCE inflation year over year, which is what we've been talking about as the Fed's preferred measure of inflation. And so you see this correlation, perhaps not as tight as PPI and consumer prices, but China PPI, again, perhaps as a leading indicator of sorts, with those prices coming down, that it should manifest just one more data point that helps us, draw the conclusion that this should manifest in lower overall consumer prices here in the U.S. So we've got two measures here. We've got on the left-hand side is consumers' expected inflation over the next year. And then on the right-hand side, we've got the firms expected. So this is the commercial sector. So you've got consumers on one side, you've got the commercial sector on the other. What are their inflation expectations? As you would expect, directionally, they're kind of in the same ballpark. Interestingly enough, over the next year, consumers, their expectations have actually perked up a little bit. So now we're above 4% for their expectation over the next 12 months. And then as you can see here from the commercial side, their expectations are a little bit more robust. They're looking at something closer to 5.5% to 6%. And so again, going to this notion of that it's just going to take a while for inflation to come down. But as you'll see in the next slide, that the longer term expectations are clearly grounded at lower levels. Here is some data from the New York Fed survey of consumer expectations. Good data work here by the New York Fed. And then what we have here is in the blue line represents kind of that line that we just examined, the 1 year ahead inflation expectation. And then in the red, we see here the 3-year expectation, looking out 3 years. And then in this kind of this amber-ish line, you see the 5-year, and you can see that, as you extend the timeline out, the expectation is clearly much more grounded at levels that we have been used to over a longer period of time. And so, again, this reinforced notion that it's just going to take us a while to get to this preferred level of inflation. Here's household income growth expectations. You can see that they were elevated post-pandemic with a lot of the stimulus money that was paid out. And we've got some other data that's kind of tied to spending and consumer activity coming up. But you can see here this rolling over a little bit. Income growth expectations are clearly moderating off their peak right now. So here we have CPI year over year, average of utility costs, gasoline, food at home, and electricity. And then in the shaded bars represents recessions. And so, when we look at the consumer right now, there are elements of the consumer price basket that are actually trending in a favorable direction. And this represents that. So when you think about utility costs are off their peak, maybe they're higher than they were, but they're off their peak. So that makes people feel a little bit better. Gasoline at the pump, again, a little bit, definitely off its peak, maybe a little higher than it has been. But again, people feel a little bit better about that too. And then so, we see several of these items that have kind of retraced these massive gains, as you see here, going back to, really the 1985, where you've seen a tremendous amount of oscillation around zero, around the baseline here. And we have definitely reverted back to that in some respects. So, for all the kind of the adverse data points, this is one that you might look at and say, things are not as bad, but they're clearly still above levels that we've experienced in the past. Here's household spending, again, from the New York Fed survey of consumer expectations. You do see that rolling over, albeit at a higher level than we've seen. So we've got some more data coming up with regard to consumer savings and spending and things like that that kind of help to ride side saddle to this. But obviously with the pandemic stimulus money and increased wages, you've got more horsepower. You had consumer balance sheets that heading into the heading into the pandemic were actually in pretty good shape. And so there was a lot of embedded firepower in this number and in this trend. So consumers had the increased wherewithal to spend, and obviously they did. But these are expectations, and so obviously it's as much a byproduct of what consumers do as what they say they're going to do. And so here, clearly we see consumer spending growth expectations trailing off somewhat. If we look at aggregate excess savings here, this is from actually a paper that was emanated out of the San Francisco Fed. Very interesting work here. And if you look at these historical patterns, after the onset of recessions, and so what this black line is referring to or pointing to is the 2020 pandemic shutdown, where we had that very brief recession. And so, the months since start of recession here, we're still actually analyzing that, but you can see after the recession started, we had a lot of stimulus payment go out, and so that bolstered excess savings. And you can see that clearly in this bump here, which is something that we haven't, we didn't realize in prior recessions that are also noted here on this chart. But you can see how that's really rolled over now. So we've really dug into that excess savings to help facilitate all of this spending, which at the consumer level, which represents 2/3 to 70% of the economy, has actually been pretty strong. And so at various points last year, when we were speculating over the potential of a recession in 2022, we always looked at consumer spending and excess savings as a reason why it would be very impractical to assume that we were going to have a recession. But as this number rolls over, it kind of lays the groundwork for slowdown in consumer spending, which generally will help lead and confirm a recession. But as you will see here, and even in this chart too, and in a couple of charts that I've got coming up, that it's going to take a while. We still have excess savings, about essentially $500 billion of excess savings that we've got to burn through before it becomes a real problem. Again, from this San Francisco Fed report, I thought this was interesting. So you got personal savings as a trend line going back to 2016 here. And then you've got the pandemic in 2020. You see the shaded bar represents that brief recession that we had, and the spike, and that green shaded area represents the accumulated excess savings. A lot of this had to do, obviously, with the stimulus checks that were going out. And then, as you can see here, very clearly heading into 2022, we were starting to dig into that. And so we were moving into a negative excess savings mode, although we still have excess savings out there. We just don't have nearly as much as we did. And that was confirmed in that last chart. And also the final chart from the San Francisco Fed study, which I thought was particularly interesting, and we'll see this in the next slide ahead, that this is a breakdown of financial asset allocations between liquid and illiquid assets. And you think of liquid assets are the assets that checkable deposits in banks, what you can spend, what you can go out and buy durable goods with, what you can go out and spend on Amazon deliveries and things like that. And the blue represents illiquid, like your home, your physical assets, cars and real estate and property and things like that, things that you can't quickly monetize for consumption purposes. And as you can see here, the x-axis actually represents household income distribution and these allocations from the lowest income tiers to the highest income tiers. And what you see here very clearly is that compared to before the pandemic, the lowest tier of income earners actually has more liquidity available. And you can see that at all levels, generally speaking, that we have more liquidity than we did prior to the pandemic. What's interesting of note here is that at the highest income tiers, we tend to have much more. Obviously, at the higher income tiers, you're going to have more overall net worth and net assets, if you will. But generally speaking, at the upper income tiers, you have less of that higher levels of assets in liquid form. Now we're going to transition into some B of A data. And here we have something I thought was particularly interesting, and it is a foreshadowing of slower consumer spending. We see here on the left-hand side a breakdown of after-tax wages and salary by income group. And so they break this down into three areas. The blue represents under $50,000 of income. And you can see you can see that growth kind of dovetail with the red line, which represents that cohort between 50 and 125,000 of annual income. And then what's notable here is that that those two areas are still positive, even though they've rolled over consistently dating back to 2021. But the notable thing in this is you look at that amber line, and that represents your highest income earners. And those wages and after-tax, after-tax wages and salaries have actually been in net decline, and they've decelerated faster than the lower income cohorts. So transition over to the right side here. We've got discretionary spending per household. And as you look at those same cohorts, and both a 6-month and a 1-month change, you can see the 1-month change for the upper income earners is actually negative. And so when you think about the aggregate consumer spending out there, a lot of it is being driven at the upper income levels. And if your upper income levels are witnessing wage declines and also discretionary spending declines, and that is a clear foreshadowing of slower overall consumption and consumer spending. Here we have from Bloomberg, this is credit outstanding, particularly on revolving credit. And you can see here clearly these bars spike up in 2021 after nosediving during the pandemic. So what this represents is people that are spending on their credit cards. They're increasing their credit card balances. And while you may argue that the trend looks like it might be rolling over, the last data point was pretty high. And so usually in a very cyclical and very normal economic cycle, you're going to have consumers that in the later stages, when income begins to drop off, they're going to use their credit cards. They're going to leverage up. They want to maintain their spending patterns. And so they're going to use this revolving credit as a vehicle to sustain that. But that's self-limiting because you get to your credit card limits, you max out, and then you can't spend anymore. And we are getting closer to that. Now, again, like I said before, we do have excess savings still out there, but they are going down. And then if you assume that on this slide, if you're beginning to kind of hit a terminus or like limits on the ability to expand revolving credit, then just more fuel for this argument that that consumer spending is apt to slow. And here we have individual tax receipts. So this is more of a government fiscal issue here. So this whole issue about the debt ceiling being raised and the debates over is that going to happen? Are we going to go into default? So on and so forth. I honestly think that there is a pretty wide gulf between the Democrats and Republicans right now on where they stand with the debt ceiling. But the issue here in this chart is that that tax receipts for the current year, which is in black, is well below what we saw last year. And so what that means is that the Treasury has less money this year than it had last year at this time. And Treasury receipts are very cyclical. So as you can imagine, around tax season, they get a huge infusion of cash. And the issue this year is that cash infusion is just less than it has been, and certainly less than it was last year. But honestly, I do think that the nuclear option in all of this is to invoke the 14th Amendment, which states that the U.S. will honor all debts. And so that's just kind of a blanket nuclear option that says, all right, we have to, kick this can down the road. And honestly, I do think that that's probably what happens, that we move this down into the September after the Labor Day recess, or even to December, so that negotiations can continue. Here's a chart reflecting essentially what I mentioned in that last slide. On the left-hand side, federal budget deficits, generally during tax season, you have a surplus, and you can see those two circles there. Last year was obviously much greater than it was this year, and so tax receipts are just less than they had been. You can see the numbers down below that, and kind of track to different years, and you can see where we fit in relative to prior years, and that obviously we're running below trend line. Now, you see the red and the kind of that orange line there represents 2020 and 2021, and we know what was going on then. But clearly in a more normalized environment, you would expect to see these receipts be a little bit higher. So again, this is just something that's important when you consider, when does the government run out of money, as so to speak, amidst these deliberations. On the right-hand side, we've got interest payments. And this is something that, from a budget standpoint, not necessarily right now, but clearly looking ahead, we're going to have to wrestle with. And this is, as you increase your debt load, you increase your deficit spending, in a rising rate environment, your debt service is going to increase. And this is a clear representation of that. So interest payments are rising because of higher inflation and, as a result, higher interest rates. Now we're going to transition into an area of the economy that is going to be exhibiting a lot more headwinds, I think, coming up. And that is the office commercial real estate market. And here we have office vacancies for several of these major markets. And you can see the rapid acceleration here, very notable acceleration. And you can see that prior to the pandemic, that we were witnessing, net absorption, which was leading to new spending on new capacity and new construction. And then we had the pandemic, and of course, all of that new construction was, created an exposure for this industry, because now we have excess capacity with the future of office evolving before our very eyes right now. And you can see the spike in vacancies. And these are just three major markets, but this is really a national issue. And here's some work by BlackRock on the commercial real estate sector. And so, as interest rates rise, you tend to see higher capitalization rates. And what does that mean? So when you think about rising rates, there's like an inverse effect. So when rates move higher and cap rates move higher, the value of real estate moves lower. So low cap rates, which we have enjoyed, you could see the decline in cap rates over the last decade, clearly on all three, industrial, office, and retail. You could see in retail, it began to pick up in 2018 before the pandemic. But you can see now clearly after the pandemic that these cap rates are moving higher, as you would expect in a rising rate environment. And where they're moving up the highest is in that yellowish line there in office. And you can see the rapid acceleration there. Really the only area that you could point to within the commercial real estate market that's kind of still hitting on most cylinders, and that's the industrial side. That's true here locally, and it's true nationally as well. But obviously, office and retail are the key areas that we want to focus on looking ahead. Now we have the senior loan officer data. Now this is essentially the demand for and the supply of credit in the market. And, when you talk about economies that are expanding, generally that's because you have an expansion in credit. You have more favorable lending standards so that more people can get credit, they can expand their businesses, so on and so forth. Well, we're in the inverse of that now, and we have been for some time. So these charts tell the same picture, but from two different perspectives. On the left-hand side, we have the net percentage of banks that are reporting stronger demand for C&I, commercial and industrial loans, and you can see that number is going down, not only for large and middle market firms, but also for small firms. And we could see that begin to manifest even before the Silicon Valley Bank failure. And if anything, that has only accelerated that, because the small and the medium-sized banks tend to do a majority of the C&I lending. And we know that those folks have seen a bit of a deposit flight to the larger firms. But in both categories, we're seeing a fairly strong drop in demand for C&I loans. On the right-hand side, we've got a rising rate, again, for large and middle market firms, as well as for small firms, a tightening in credit. So when you look at that last slide and you transmit it into, okay, well, what does that mean for the economy? What does that mean for, for key data points looking ahead? And this is a chart from Bloomberg, which really tells that story. So, when you have lending standards that tighten as they have, that tends to foreshadow an increase in bankruptcies by about 6 to 9 months. And you can clearly see that in the data here. So as we've seen this rise, would expect to see a rise in bankruptcies as we head into the latter months of the year. Here we see interest coverage ratios on leveraged loans sliding off a little bit. Again, very cyclical. You'd expect to see that in a slowing economy. And you're clearly seeing that now in those blue bars beginning to trail off. And here's something that's not discussed often. This is Chapter 22. So this is repeat bankruptcy filings by the same company. And as you would expect, this is also somewhat cyclical. You can see back here in the global financial crisis, 2008, 2009, that we had a spike. And you look at the latest data reading, we did see in the pandemic a little bit of a bump there. But we've had a recent spike lately, and so you dovetail that with the slide that we just showed you, that this foreshadowing, with tighter credit out there, and companies not being able to roll over their loans, that we're apt to see this continue to move higher. Then transitioning over to the consumer side, we've got credit conditions. You can see this dramatic rise that by this analysis, which is from University of Michigan and Haver Analytics, that we're actually above 2008 levels. So this is, credit conditions for large household good purchases. And you can see that very mercuric rise here, dating back to the beginning of last year. Then from the latest data that we have here, initial claims for unemployment benefits, you see here in the black that it is trending higher. It's moving higher. So we have still a very strong labor market, but it is showing some signs of weakness. So you've got that black line there that it's trending above prior years. So that's on the one hand side. And you see that data represented a little bit differently here on the right hand side, where you've got these weekly numbers. And this, this goes back to the beginning of last year, and you can see in that dotted line the 2019 average, and you can see here lately that we've been popping up above that. Here's a homebuyer affordability index, a little bit of a hook down lower in the latest reading. We know that it has trended down Again, this is a data series that goes back all the way to 1990. So to get to the last couple of years, you really have to hug the right side of this chart. And obviously, as home prices went up, interest rates moved higher, affordability dropped. And just the takeaway here is that it remains very low. Here we have the median sales price for existing single-family homes on a one-year change. And this is kind of tracking it over the last 3 quarters. And you could see that the median sales price has, by and large, trended lower, certainly from the third to the fourth quarter of last year, and even continuing into the the first quarter of this year. And you can see it's not similar trends in all areas of the country, but worse in some areas. You've got the West that's actually an outright price decline for a median sales price here, and you've got the Northeast, which is probably in a similar ballpark, even though it's roughly flat. And then you've got the Midwest and South that are faring a little bit better. But in every case here, you see that these sales prices are moving lower. Here we have just kind of the health of the real estate market in general. The homes for sale on a year-over-year change. We've got active listings, which we were moving higher. Obviously, with higher sales prices, a lot of people were trying to get their homes on the market, and then that really just dropped off like a rock. And you can see that drop here, and then new listings continuing to trend lower. Now we'll transition into the investment markets. We've got a chart here, several pieces of data on it, but really focus first on these blue bars. And this is the months in between the last rate hike, which we may argue we just saw here in the latest Fed movement, to the first cut. So the difference between that last hike and then the first cut, and the average number of years is about 6, but the median number of months between the last hike and the first cut is about 4 months. So with that, if we assume that we just saw this, then we'll have our first cut perhaps in the late third or fourth quarter of this year, which the market's expecting several cuts by the end of this year. Again, I'm not sure that we're necessarily going to get that. I think the Fed is pretty much with rare exceptions that I mentioned earlier, I think is in this kind of a holding pattern to see how this data flushes out. Now, the numbers that sit above these bars actually represent the number of months from the last rate hike to when we see recession. And with some notable exceptions, I mean, you can measure it in a handful of months. And so, again, this chart, what it tells me is that that we're likely to see this kind of recession or slowdown kind of perhaps pick up a little bit of steam towards the second half of the year and maybe persist just into 2024. But that's what the data is telling us right now. We're going to talk about the stock market here for a little bit. As we reflect on the year to date, where we've had a little bit better performance, obviously coming off a very sluggish and regrettable and forgettable year last year overall in the investment markets period. Here, what we have is kind of a changing of the guard. We've got a few slides on this, and I think the implications are pretty interesting, and we have to take stock of maybe those implications. We'll talk about that over the next couple slides here, but you can see here as you go back into the post-pandemic, the shutdown and the reopening, that growth was dramatically outperforming. We had huge outperformance by a very narrow section of the market, those being the FAANG stocks, the Google, Microsoft, so on and so forth. And that changed rather dramatically at the beginning of 2022. And we had a shift into value, even though, the market was sluggish in most respects, but value outperformed. And so that's turned around a little bit. Now we see growth reasserting itself at a rather unusual time where maybe we have some an overall strong economy, but is showing some weaknesses. And typically, you don't see growth stocks outperform when you hit an economic slowdown. You tend to see them reaccelerate once you're out of that slowdown. And so the timing is not particularly good for growth stocks to exhibit this kind of outperformance. And I think it could lead to some volatility. And here we have kind of the representation of that change in a slightly different way. So what we're looking at here is the S&P 100 index divided by the S&P 500 index. So what this represents is not just the difference between growth and value, but rather large and small. So this is, looking at the largest 100 companies that would be in the S&P 500 index. And you can see that last year they did not provide the leadership. It was a broad-based and frankly a broad-based decline. So there was very broad representation across the entire index of what happened last year. However, this year it's a very narrow leadership in these gains that we're witnessing in the market, and you can see that very well defined here in the orange line that represents 2023. That the largest companies and frankly, the largest 5 to 6 companies are really driving the boat this year. And to really emphasize that point, we've got a chart here that I just came out and just grabbed me looking at it this week. That we now have Apple's market cap overtakes the entire Russell 2000 index, which is just amazing. And we've been kind of like straddling that for some time. But the fact that now that we've seen Apple as part of the FAANG stocks of that group of 5 or so companies that makes up a dramatic, literally about a quarter of the entire S&P 500, that Apple alone has overtaken the Russell 2000 index. Here we have a couple of points of analysis on the S&P 500, and looking at essentially year to date, and maybe even going back to the last major downturn in the market, which is kind of in that September-October timeframe. That the market's basically been led by multiple expansion. And what do I mean by that? So multiple as defined by price to earnings ratio. Prices have moved higher, but earnings have not. And the earnings are represented here in this amber or orange line. And you can clearly see that they haven't really moved that much. In fact, if anything, they've gone down. And if anything, we expect them to continue to be sluggish and continue to go down. And so, what we have here is multiple expansion, which you typically just don't see when you're dealing with higher interest rates and inflation. And continuing this discussion of this gradual slowdown, we see here the FAANG stocks, which, Facebook, Amazon, Apple, Netflix, and Google. You can see from their peak back in 2004, 2005 that we've seen a pretty dramatic deceleration in revenue growth. And of course, revenue is the mother's milk of earnings. And these are the stocks that have led the market this year. And if you look at these stocks and say, listen, they're leading the market, but revenue is decelerating to, very low single digits in some cases, what does that tell us for, for future performance here? So now with this slide, we're going to, kind of marry up the data on the market with the data that we talked about a few slides ago on the senior loan officer survey and the fact that credit is tightening. We're going to marry these two up now. So what this shows us here in the red is the senior loan officer survey. So we know that banks are tightening credit. This is an inverted curve. So the fact that the red is moving lower means that credit is getting tighter. And then you overlay that with the S&P 500 earnings growth number. And so you see that in the blue line. And so there is a relationship here. And so the relationship or the conclusions that's being drawn from this chart is that with tighter credit conditions, it's going to weigh on earnings growth. And I think, credit is not going to get looser until we hit a new economic cycle. And so that's going to put pressure on earnings, which, again, looking at the backdrop, you've got very narrow leadership in the market. These FAANG stocks are kind of driving the boat right now. Growth is driving the boat right now, but earnings are decelerating, and that does not tend to lead to outperformance by growth. And so I think we do have some volatility on the horizon here. With all that being said, what does the near-term outlook look like for stocks? And you can see this is kind of an expectation of a survey from IMI through S&P Global investment managers. And you can see here healthcare, staples, again, very cyclically resistant. You still need healthcare in an economic downturn. Consumer staples like Kimberly-Clark, you still need nasal tissue. And things like that, toilet paper, and those things are pretty cycle resistant. But then other areas that are more discretionary, you see outright consumer discretionary, not expecting much performance. Materials, financials, obviously much in the news lately, and then of course what we've just talked about, real estate. And I thought I'd end on this slide, kind of an interesting slide. You've got some information on banking from Goldman Sachs. On the left-hand side, it shows you that the U.S. has about 4,200-ish or more banks. And it shows you how that compares with other countries around the world. And obviously, U.S. is the largest, in terms of the contribution to global GDP. But we clearly have a lot of banks. And you can see even though banks on the right-hand side have a number of banks have gone down by 75% over the last 40 years, that we're still at a pretty high level. And so, when you think about Silicon Valley, First Republic, and kind of the stresses on the market, just consider that we have a lot of banks out there, and a lot of room for banks to continue to have some trouble in this environment. Well, that will do it for this week. A pretty loaded chart pack this week, but a lot of really good information. Hope you've enjoyed it. Have a great week. Talk to you again soon.